I'll bring it back to Buffett again. So Buffett loves banks. People think about Buffett, they come to insurance. Before he got into insurance, he got into banks. So what are some of the banks Buffett has owned? Bank of America, Goldman Sachs, Ally, American Express, Wells Fargo. Buffett loves banks. Why? A bank lets you borrow short and lend long and capture spread and compound with non-callable financing unless you get a bank run. FDIC insurance helps protect against that. And obviously, you can term out your debt with certificates of deposits and all the rest. You can issue bonds and banks, and there are a few other industries like this, but banks have this set of properties that matches all the things we talked about before. First off, you got a moat. It's hard to acquire a bank. The barriers to entry are significant. They shouldn't be that significant, but they are. That's why JP Morgan's not facing competition from Amazon's theoretical bank branches or Google, why they're not competing with them with the card, or why Tesla is now in the auto financing business, which would help them grow their income. These big tech companies have a ton of capital. They can borrow cheaply. They can build technology. They can build great user experiences digitally or embed them in retail branches like Whole Foods. The JP Morgans of the world are insulated from competition, which is a great attribute. You want a moat and you can compound, right? So if you own a bank, the old joke about banking is it's like the 5-3-5 club. You lend at 5, you borrow at 3, and you go home at 5. If you're a community banker, it's like the 5-3-2 club. You're going home at 2. In general, if you look at the quality of management in banking, it's pretty low in community banking. The quality of management at the largest banks in the United States are actually very high on average. They're actually quite high. But in community banks, these are very simple businesses. They generally make commercial real estate loans, which is probably not the category I would focus on. I don't think it's the best category, actually. But what does that tell you? What is another thing Buffett says is you want to invest in a business that any idiot can run. The community bank sector doesn't have the best quality management. Now, running a bank is complicated. It's highly regulated. The regulations increase each passing year. Now, there are lighter regulations for smaller banks, which is an advantage versus larger banks that have to comply with pretty onerous requirements. In fact, the businesses like Cross River Bank acquired my prior startup, Pure IQ. That bank started as a community bank in Teaneck, New Jersey. It was acquired by the founder and investing group for $10 million. I want to say like in 2008, 2009. 11 years from a $10 million purchase price to $3 billion. Now, maybe markets have corrected. Maybe that $3 billion is worth $2 billion. Does it really make a difference? No. Here's another one. Live Oak Bank, started by Chip Mahan, and who's an incredible entrepreneur. I've had a chance to spend time with their leadership team. That charter was also started in the 2008 timeframe. I don't know what the market cap is now, but it's gone up substantially. And they spun out a company called Encino, which is worth multiple billions of dollars. If you have good management and you find a good niche to build around and focus, here's another one for you. First Republic Bank, obviously is not with us anymore. It's been gobbled up by JP Morgan. So First Republic, I was actually at Merrill. I played a small role after the acquisition to help integrate this into Merrill. But Merrill bought First Republic, I want to say like 1.3 billion or so. And I got a chance to look at the P&L. And I was like, wow, this is an incredible business. So what First Republic did is they were originating jumbo mortgages. These are mortgages that Fannie Mae or Freddie Mac don't finance. So there's a gap in the market there. And First Republic was then sold by Merrill to General Atlantic, world-class private equity firm, right? In 2008 crisis, Merrill needed capital and liquidity. First Republic went public by GA for about like $1 billion and change. And in 2021, from trough to peak, First Republic went up 40x, about $40 billion in market cap. 40x return, that's outstanding. That's better than many of the big tech returns. Now, I went to zero, not because of the business model. It went to zero because of gross negligence on the CFO and the CEO's part. Namely, they did not sell off their fixed rate mortgage portfolio. So when interest rates widened, the value of the assets that they were financing declined, and that wiped out their equity. And they were acquired by JP Morgan, who happens to be the number one leader in securitized products for mortgages. In fact, we actually made that prediction and that JP Morgan would buy First Republic, and that's exactly what happened. That's why. So the business model was very good. They did not risk manage. They didn't finance the mortgages correctly. They could have just sold it to JP Morgan. They would have been fine. Those are quick examples of banks that have done extraordinarily well and are internal compounders. And guess what? Banks are cheap. We had a regional bank crisis, spring of last year, banks are still cheap. I own a bank with a 7.6 PE ratio that's internally compounding. And the opportunities for banks to get after gaps in the market is significant. The jumbo mortgage gap is one. The Puerto Rico market is another. A lot of ultra high net worth investors or individuals that are entrepreneurs, exited founders, GPs of private equity funds, and all the rest. And you cannot get a jumbo mortgage in Puerto Rico. Banco Popular is a leading bank in Puerto Rico, by the way. Can't get a jumbo mortgage. There are private credit funds that lend, they'll give you financing, and the rates are absurd. The only game in town. That's an example, but you could go on and on and on. Middle market financing. These are the categories where if I owned a bank, I wouldn't focus on the commercial real estate, providing back leverage to private credit funds. So the private credit, as you know, is a big new trend, been actually a trend since the 2008 crisis, $1.5 trillion asset class, right? The regulator said, hey, look, bank, if you touch credit risk, I'm going to make sure you hold capital against that. So your economics are worse off, right? Your return on equity is going to be lower than it was pre-crisis. And so what happened? Blackstone, Apollo, KKR, and many others have stepped in to do lending that banks were previously doing before. So the new trend you're going to see, Live Oak Bank is doing this now, for example, I mentioned them earlier, is banks are going to lend to the lender. They're providing back leverage to the private equity firm. The private equity firm is originating, acquiring, underwriting the borrower, going to the bank with a loan package and saying, here's a portfolio of 100 assets, cross-collateralized. Can I get financing on them? That is what's happening. That's the transformation of bank versus private credit lending that's playing out right now. I would try to index against that theme. But how do you do it? Which funds do you underwrite? How do you source this opportunity? Go to the good private credit. There's a lot to work out. But those are examples of an opportunity where you can build a Buffett business. And banks are into consolidation as well, right? I think 15 years ago, there's 10,000 banks. Now there's 4,000 and change. And the number one predictor of when a bank gets acquired is the age of the CEO. So the age of the CEO, and related to that, do they have an heir? Because these are multi-generational business. Look at FCNCA. FCNCA is a ticker. I think it's First Citizens National Bank. So they acquired SVB, Silicon Valley Bank, which of course blew up last year. They bought it from the FDIC. That bank has outperformed the S&P 500 for decades. I'm not saying go buy that stock today, by the way. I looked at it the other day. Now's not the right time, But that stock has done very well. It's a bank. It's run by a family. They've done very well. They know their niche. Their niche is picking up troubled, discounted assets from other banks, and they know what they're doing. They've got a playbook. Live Oak Bank has a niche financing veterinarians and funeral homes, for example. They have salespeople that go out to the veterinarian universities and they establish a relationship at graduation. How do we finance you? Equipment finance for doctors. Great businesses. Their niche, they're too small for JP Morgan, Bank of America, and Citigroup to get after. Those guys are financing large multinational corporates. They're trying to conserve liquidity and their cost of financing is going up to keep the deposit. And they're dealing with commercial real estate issues, which is not the best category to be lending to. I think the banking sector is a tremendous opportunity to build a world-class franchise, internally compounded, take advantage of the dislocations that are out there and the fact that these assets are cheap right now. You can buy assets below replacement cost. I mean, I haven't checked Barclays recently, but the price to book ratio is 0.6, meaning like if you sold, it was like 4 or 5 months, I don't know where it's today, but if you sold Barclays, every line item in that balance sheet, you would get more cash than the price to acquire those assets. Citibank, same thing. So banks are cheap right now. And the other point is that the markets, public markets, aren't valuing these businesses correctly. Or you could say that in private hands, you can compound them better and you'll do well. So some assets just are not rewarded well in public markets. They're cyclical. They go up and down on the cycle.